Have you ever felt like you're just lost in this maze of financial jargon? All the conflicting advice trying to figure out your investments?
Or maybe you're just looking for, a clearer way forward amidst all the noise out there.
Yeah, you are definitely not alone in feeling that way. Welcome to the Deep Dive. This is where we try to cut through that noise and bring you the essential stuff. Today, we're really digging into the timeless wisdom, even if it feels a bit counterintuitive sometimes, from Jack Bogle's Common Sense on Mutual Funds.
Uh-huh.
Our mission is basically to give you a shortcut, a way to be genuinely well-informed about mutual funds, focusing on what actually impacts your financial future.
Right.
We want to unpack why Bogle's whole common sense approach, which, let's be honest, isn't always the popular view in finance, why it's still so incredibly powerful for you, the individual investor.
And we are diving into the fully updated 10th anniversary edition of his book. It doesn't just reconfirm those enduring truths Bogle talked about, but it adds some really crucial insights from, after the financial meltdown.
Okay.
It really is a kind of blueprint for understanding why sometimes the simplest path, well, it's the smartest one, the unvarnished truth, Bogle's gloomy message and unfulfilled hopes.
So, right out of the gate, Bogle, he didn't really pull any punches, did he?
No, not at all.
What was his kind of most fundamental take, that gloomy message about the mutual fund industry?
Well, he saw a real structural failure, almost like a betrayal of the average investor. Bogle was always championing you, the individual.
Right.
And his whole philosophy boiled down to two words: simple and low cost.
Simple and low cost.
Yeah. He argued that smart investing, it's really just common sense, sound reason. But the industry, he felt, kept undermining that very idea.
And he actually thought the industry was making things worse. That's quite a statement. How did he see that playing out?
Yeah, worse was definitely his assessment. He pointed to this huge shift in retirement planning, the burden moving from employers.
Employees, yeah.
Exactly. And that created massive problems. Not enough savings, especially for folks with lower incomes. I mean, the data showed something like, 88% of top earners were in defined contribution plans.
But not everyone else.
Not nearly. So, a big disparity there.
And his hopes for reform, his idea to chart a course for change, that actually failed. Things got worse.
That's what he said. He saw technology, which you'd think would help, actually making things more complex, riskier,
How so?
enabling these really complicated financial instruments, encouraging investors to treat funds like stocks, trading them with alacrity, as he put it.
Reckless speed, basically.
Yeah, trading way too often. And that leads right into this huge governance problem he identified.
Yeah.
He saw marketing dominating management, salesmanship winning out over actual stewardship.
So selling the fund was more important than managing it well for the investors.
That was his view. He said fund directors often forget that their job is to serve as fiduciaries for fund investors. He felt the whole governance structure was stacked against fund investors and in favor of fund managers.
Wow. He even used that really strong analogy, comparing it to Thomas Paine.
Yes, that the fund management companies had gained the power of kings.
And the fund boards were like the aristocracy, just going along with it.
Exactly, just rubber stamping what the managers wanted. His core message was defiant. Shareholders own the funds.
They own them,
And they ought to control them too. That was his point.
too.
The tyranny of costs. Why basic arithmetic works against you.
That is quite an indictment of the industry from Bogle, really seeing the system as, failing the average person. But he didn't just point out problems, he really honed in on the single biggest kind of silent killer of wealth. His rule, #1, keep your investment expenses under control. Why was that so fundamental for him?
Because basic arithmetic works. But it works against you relentlessly.
How do you mean?
Well, those fees that look small. The annual expense ratio, plus the costs of the fund trading stocks inside the portfolio, they add up.
Okay.
Bogle figured these could easily eat up 2 percentage points of your gross return. So let's say the market makes 10% one year.
Yeah.
Those 2% costs. They just devoured fully 1/5 of the market's annual return. Right off the top. That's a huge chunk.
And wow, it gets even worse when you start thinking about inflation and taxes, doesn't it?
Oh, absolutely. Add, say, 3% inflation into the mix. Now those 2% costs are eating up nearly 1/3 of the market's reward.
A third?
Yeah. And then taxes. They're charged on your nominal return before inflation. So costs could potentially end up consuming, get this, 4/10 of the market's net real return after taxes.
That's almost half gone.
It's a really vicious cycle. It's why Nobel winner William Sharpe said, the first thing to look at is the expense ratio. It's just paramount.
So let's make that really concrete. Imagine you invest $10,000 for 10 years. One fund costs 0.2% a year. That costs you, what, $280 over the decade?
Right. Seems small.
But another fund costs 2.2%. That same $10,000 investment now costs you over $2,800.
10 times more.
Yeah. It just shows how those little percentages become real money, as Bogle put it. Big money, really.
It absolutely is. And think about the bigger picture, like the equity risk premium.
That extra return you hope to get for taking stock market risk.
Exactly. Bogle showed that a high-cost fund, maybe 2.5% total costs, well, if the risk premium itself is only 2.5%, that fund could consume 100% of the equity risk premium.
So you took all the risk for basically no extra reward after costs.
Precisely. And even the average fund cost, say 1.5%, could easily eat half of a typical 3% premium. It's even more dramatic for bond funds because their returns are lower to start with.
Right.
You pointed out that sales-load bond funds often earned roughly 1/2 of the returns of the comparable bond index. Just shows the unwisdom of investors paying those loads and high fees.
And the long-term hit is just devastating. That 1% annual cost on $10,000 over 4 decades, it cuts the final value by 35%. He called it truly confiscatory.
Yeah. Confiscatory. That's the tyranny of costs, just silently grinding away your wealth over time. 3. The illusion of activity. Market timing, fund turnover, and reversion to the mean.
Okay, so if costs are the silent killer, then Bogle also warned about this noisy, flashy trap he called casino capitalism. This idea that rapid trading, short-term thinking dominates, and too much money goes to the croupiers, the managers, the brokers.
Instead of the investors. Yeah, he was deeply concerned about that. And he loved pointing out how spectacularly wrong market timing calls often were.
Oh, yeah. Like what?
Remember Business Week's famous Death of Equities cover?
August.
1979, Dow at 840.
Right before a massive bull run.
Exactly, decades long. Or Time Magazine, Buy Stocks, No Way. September 88, Dow at 2000.
Which then went up fourfold.
Right. Imagine listening to that advice. You'd miss some huge gains.
And sadly, individual investors often do the wrong thing, don't they? They follow the crowd, overreact.
Leading to these consistently counterproductive investment patterns. His example of the 1973-74 crash was stark. Investors pulled out $14 billion over 24 straight quarters.
Selling low. Exactly when they should have been buying, or at least holding on.
Precisely. And this manic activity isn't just bad timing. It shows up in fund turnover, too.
How so?
Well, back in the 60s, 70s, the annual turnover rate for fund shares was about 8%. That implies people held funds for like 12 and a half years. Long-term thinking.
Okay, makes sense.
Now, it's around 31%, which means the average holding period is down to just 3 years.
3 years? That's a huge shift from investing to speculating.
That's exactly how Bogle saw it. A major concern for building long-term wealth.
So, okay, if all this activity, this trading, is often harmful, what about the funds that do have a great run? Surely they can keep it up.
Well, that's where Bogle brings in Sir Isaac Newton, metaphorically speaking.
Newton, how does he fit in?
He called it reversion to the mean, RTM. Like a first principle of financial physics.
Every action has an equal and opposite reaction.
Sort of. In finance, it means funds with the best past performance. They almost always drift back towards average gross returns.
Yeah.
But because of their costs, their net returns, what you actually get, end up below average.
So past performance isn't predictive. In fact, it might predict underperformance.
Exactly. It's the paradox Bogle called nothing fails like success. The really hot funds attract tons of money. They get huge mammoth size.
Right.
And that makes it harder for them to keep delivering great returns. Yeah, this great line, the fleet-footed cheetah has become the lumbering pachyderm.
Great image. And this isn't just about fund managers, right? He had a simple way to think about stock returns, too.
Yeah, his kind of Occam's razor for stocks, he boiled it down to 3 things. Dividend yield, earnings growth, and this is key, the change in the price-to-earnings ratio.
The PE ratio. Investor sentiment, basically.
Right. And he showed how speculative swings in that PE ratio could totally overwhelm the fundamentals, the actual earnings growth.
Like in the 70s. Exactly.
In the 70s, the PE ratio decreased so much, it actually wiped out the gains from dividends and earnings growth. Shows how damaging speculation can be.
Yeah.
And this RTM thing, it's everywhere. Funds, market sectors, even global markets, like U.S. versus international stocks. Over the really long haul, they had identical 11.5% compound returns, even though they took turns leading in shorter periods.
So it all tends to average out, which leads to a really big question Bogle asked back then, looking at high valuations.
Yeah, like PE ratios around 27 in late 98 compared to just under 8 back in 82.
He asked, are stocks reverting to a new, higher mean?
It's a fundamental challenge, isn't it?
Big impact.
The idea that things just keep going up forever.
A really profound question. The power of passivity, the triumph of indexing, and the ETF paradox.
Okay, so given this, let's call it skeptical view of active management and market timing, Bogle's big solution is simple. Stick to simplicity. And for him, the ultimate expression of simplicity was the index fund. Absolutely.
Yeah.
He called the index fund the core investment, the baseline against which all other mutual funds must finally be measured.
And the performance data really backs that up, doesn't it?
It's incredibly compelling. The S&P 500 index just consistently beats the average actively managed fund over long periods.
Like by how much?
Well, over 50 years, it was about 1.3 percentage points better per year. Over the 15 years ending in 97, it was a huge 4.0 percentage points better annually.
Wow.
And it makes sense, right? All active managers together are the market before costs. Then you subtract their higher costs.
And they underperform as a group. It's that uncomfortable brute fact Paul Samuelson talked about.
Exactly. Samuelson basically dared anyone who disagreed to show evidence that active management consistently won. They couldn't.
And Bogle called this the triumph of indexing. And it wasn't just theory, right? People actually started doing it.
Massively.
Yeah.
Index fund assets just exploded. From $200 billion in 98 to $460 billion by 2009. And interestingly, during rough patches, investors were often selling their active funds but adding to index funds.
That's a huge vote of confidence.
It really is. And you get these amazing endorsements, sometimes from surprising places. Peter Lynch, the legendary active manager,
Yeah.
he said most investors would be better off in an index fund.
Wow. From Peter Lynch.
Even Charles Schwab, whose company makes money off trading, admitted only about 1 out of every 4 equity funds outperforms. That's why I'm a firm believer in the power of indexing.
Even Schwab.
And maybe the ultimate concession came from John Fossil, former chair of Oppenheimer funds.
Yeah.
He just flat out said, people ought to recognize that the average fund can never outperform the market in total.
Okay, so index funds win. That seems clear. Which makes you think about exchange-traded funds, ETFs. They often track indexes, too. So they're just as good, right?
Yes and no. It's a paradox.
A paradox.
Buying ETFs based on broad market indexes, holding them long-term, low cost.
Yeah, that's a totally sound strategy.
Okay.
Consistent with Bogle's ideas.
But most ETFs, especially the newer ones, aren't like that. They focus on really narrow sectors, things like, biotech or specific countries. Bogle felt they were like roulette wheel configurations.
Encouraging gambling, not investing.
Kind of, yeah. A casino-like attitude. Plus, they often have much higher expense ratios than traditional index funds, like 3 or 4 times higher, maybe 0.50% or 0.70% versus 0.10% for a basic index fund.
Okay, higher costs, encouraging trading. What's the ugly part?
The ugly part is shocking, actually. The returns that investors in ETFs actually earned, they were nowhere near the returns of the ETFs themselves.
How is that possible?
Bad timing, trading in and out. Over 5 years through mid-2009, ETF investors lagged the funds they owned by about 4.2% per year.
4% a year, that's huge.
It is. It meant a cumulative loss of about 20% of their capital compared to just buying and holding. This is where Bogle saw technology enabling self-inflicted damage. Easy trading isn't always good trading. The asset allocation. The foundation, distorted by costs.
All right, so with all these traps, high costs, bad timing, chasing performance, how do we actually build a solid foundation? Asset allocation is usually seen as key, right? Balancing stocks and bonds based on risk.
Yeah, that's the core idea for modern portfolio theory. Optimize your returns for the amount of risk you're comfortable with.
And the basic rule is simple enough.
Reduce stocks, increase bonds as you get older. Using your age and maybe your asset level is a wise starting point, as Bogle suggested.
But there's a misconception here, isn't there, about how much asset allocation actually drives returns?
There is a really important one. Asset allocation might explain, say, 94% of the quarterly ups and downs in your portfolio's value.
Which sounds like almost everything.
Right. But, and this is the crucial bit, it explains far less of the difference in long-term total returns between different investors, maybe only 15% in that same study.
Okay, wait. So it explains short-term volatility, but not necessarily long-term results. That's a big difference.
Yeah, huge difference. It means other factors are really driving long-term success.
So if asset allocation isn't the whole long-term story, what is?
This brings us back powerfully to costs. Analyst William Janke made this really striking point. For many individual investors, cost is the most important determinant of portfolio performance.
More important than asset allocation, or market timing, or picking stocks.
Not asset allocation policy, market timing, or securities selection. That was his conclusion. And Bogle added his own critical note. He said, yes, your investment strategy matters, but it's dwarfed by your overall investment policy. And the total return is severely impacted by costs. Costs always loom large.
So it's about getting the basic policy right, like a sensible stock bond mix, and then keeping costs absolutely minimal.
Exactly. Find that balance. Bogle liked a simple, balanced approach, maybe 70% stocks, 30% bonds for retirement. Something validated over centuries, he said.
Provides solid long-term returns.
Without excessive short-term risks. Yeah. It's about being thoughtful, strategic, not frantic and costly. 6. The ultimate weapon. Time, magic, and tyranny and lead.
You know, we talk about return, risk, cost. But Bogle added this fourth dimension, time.
Yes, the fourth dimension of investing. And he saw it as having two sides, magic and tyranny.
Okay, let's start with magic. That's compounding.
That's the magic of compounding. Yeah. It's just incredible when you see the numbers. Start with $10,000, earn 10% a year. After 10 years, you've got $26,000. Respectable. But let that same investment ride for 50 years. It grows to almost $1.2 million.
Wow, from 10K.
120 times your initial money. That's the exponential power of time working for you.
Incredible. But there's the flip side, the tyranny of time. What's that about? It's the cost of delay, isn't it?
It's the steep cost of delay, absolutely. Yeah. Let's use an example. Say you want to have $500,000 saved by retirement.
Okay.
If you start saving at age 20, you might only need to put away, say, $79 a month.
$79. Seems manageable.
But what if you wait until age 50 to start? To hit that same $500,000 goal in a much shorter time, you'd need to save a staggering $2,174 a month.
Whoa, from $79 to over $2,000.
Yeah. The longer you wait, the more, as Bogle put it, Everest-like the climb becomes. You need these massive contributions just to try and catch up. Time becomes your enemy.
And this connects right back to costs, too, doesn't it? The tyranny of compounding costs.
Exactly. Because cost matters hugely over time. Those seemingly small differences in fees, time blows them up into increasing and finally staggering differences in capital accumulation.
So the high-cost fund doesn't just lag a little each year.
It loses ever more ground to a lower-cost investment as the years roll on. Time amplifies everything, the good of returns and the bad of costs. 7. The call to action, serving two masters.
So let's bring it all together, back to that core conflict Bogle saw right at the heart of the industry, governance. This idea that fund directors are supposed to represent shareholders.
But their actions are often sharply tilted in favor of the fund's management company. Shareholder interests end up being subservient.
And he had evidence for this, right? It wasn't just a feeling.
Oh yeah, clear evidence. He pointed out, for instance, how funds with higher director fees also tended to have higher management fees paid to the company.
Cozy relationship.
And directors often owned little or no stock in the actual funds they were overseeing. A huge conflict of interest, right?
Definitely.
Plus, think about this. When a fund management company gets sold, often for billions, maybe 3–5% of the assets they manage.
Yeah.
Not one penny of that value created by the shareholders' money, goes back to those shareholders. It all goes to the owners of the management company.
That seems fundamentally wrong.
It led Bogle to invoke that powerful quote, "No man can serve two masters."
Defining the shareholders as the ones who should be served.
The gods who are to be served, he said. And the wealth grabbed by the managers, that was mammon. Material gain put ahead of fiduciary duty. It's a really profound ethical point he's making.
Absolutely. Which is why he championed the Vanguard structure, isn't it?
Exactly. Vanguard's unique setup, mutualized, internally managed, where the funds actually own the management company.
It aligns the interests.
Perfectly. It allows them to operate at costs way below industry norms, maybe 75% lower, saving shareholders billions every year. It shows it can be done differently.
So, faced with this industry structure, what was Bogle's final call to action for us, for the individual investor?
He called for transparency, first off, But critically, he urged investors to vote with their feet.
Meaning, move your money if you're not being treated fairly.
Exactly. Demand that managers cut fees to equitable levels. Demand a return to real long-term investing. Demand that the focus be on human beings, both the clients and the people working at the fund company, not just maximizing management company profits. It's really a call to bring common sense back. Outro.
So if we boil down Bogle's enduring message from this deep dive, it's really embrace simplicity.
Yeah, and prioritize low costs.
Yeah.
Relentlessly.
Commit to investing for the long term. Don't get caught up in the noise.
Understand that incredible power of compounding both the magic for your returns and the tyranny against you with costs.
And finally, demand that the funds you invest in actually serve your interests first.
Right. And these aren't just, complex ideas for Wall Street experts. This is common sense. Tools that you, the individual investor, can actually use.
To navigate the markets better, build real financial security.
And just gain some peace of mind, frankly.
Yeah.
In a world that often seems designed to confuse you.
In this financial world that seems increasingly obsessed with frantic trading, with complex, expensive products, Bogle's steady call for simplicity, for low-cost indexing, it almost feels radical sometimes.
It really does.
But maybe, just maybe, for your own financial future, the most radical and the most powerful thing you can do is simply stay the course.